webcast. I'm Larry DeBoer, professor in the Agricultural Economics Department here at Purdue University, and off at another location, a secure location no doubt, is Extension educator and regional specialist Tamara Ogle, off in Rossville, and she'll be running the board and taking your questions and troubleshooting and all that good stuff. Today we're going to talk about a couple of public policy experiments that Indiana is about to embark upon, an experiment with our local income taxes and another one with farmland assessment. And I call these things experiments because we're really at the beginning of them. Both of these things take effect officially on January 1st, 2017, though some of their effects are already out there, and we'll talk about that. But they are experiments, and we at least I am eager to see just how these two new efforts work out. And as always with experiments, you don't exactly know what's going to happen. And of course, the trouble with public policy experiments is we are experimenting on ourselves. So we are the rats in the maze as far as this experiment is concerned. So I'm going to start out by talking about the local income taxes, maybe spend 20 minutes to half an hour on the local income taxes, and then the rest of the time on farmland assessment, which I think at the moment is the more complicated of the two. So let's get started with the changes we're going to make on local income taxes. Okay, well, it was House Bill 1485 passed in 2015. That was the session before this most recent one. That a very important reform of our local income taxes was passed. And, you know, our local income taxes had sort of accumulated over the years, starting in 1973 with the CAGIT tax, the County Adjusted Gross Income Tax. And then in the early 80s, we invented the County Option Income Tax, the COIT tax. Then in the late 80s came along CDIT or EDIT, the Economic Development Income Tax. And then in 2002, we came up with a inventory tax replacement that was attached to CDIT. And then in 2007, we had three more property tax relief local income taxes, along with a public safety tax. And so by the time we reached 2015, there were, depending on how you count, 3 or 7 or maybe a whole lot more different flavors of local income tax in Indiana. And believe me, as a person who began attempting to explain this stuff way back in 1984, it's only gotten more complicated as we went along. And by the time we hit 2015, it was quite complex and quite difficult to explain. And in order to address this complexity, we had House Bill 1485, which is now part of Indiana Code 3-3.6. And the purpose of this, as you see, I put the little preamble to the bill at the top, the first bullet point there. Let me read it to you. The purpose of this article is to consolidate and simplify the various local income tax laws, referred to as a former tax in this article, that are in effect on May 1st, 2016, into a uniform law that transitions each county from the former taxes to the tax governed by this article. I think the very first thing to realize about this reform is that it is not an attempt to change anything that the counties are doing right now. And in fact, the budget agency and the DLGF went to great effort to take what did exist in the taxes that we have and the tax rates that we had, the purposes of those tax rates and who the money was distributed to and all of that, and translated it into the new system with no changes at all. And I think they achieved that. Certainly no tax rates were changed by this law. The whole point of the thing was to consolidate, that is, take all 7 of our taxes and consolidate them into one, and to simplify, to make it easier for folks or taxpayers to understand, easier for policymakers to understand, even easier for the Department of Local Government Finance to understand. And so consolidate and simplify was the purpose of this. The theme, though, from what I'm going to talk about here, is that once we get this reform, I think the increase in flexibility for policymakers may cause, over the next couple of years, some rearranging of the way our local income taxes look. And so as we go through this, as I talk about the changes that are made, I'll try to point out where I see additional flexibility for policymakers. Well, just some details about how these taxes work, and this was true before and is still true. The tax can be adopted, altered, or rescinded by the county council or by the County Income Tax Council, depending on which of those two first adopted the former local option income taxes. Now, generally, if you had CAGIT, you're a county council county. If you had COIT, you're a county income tax council county. If you had CEDIT without CAGIT, you might have been a county income tax council county. There are a number of areas where the old system, the CAGIT, COIT, CEDIT system, will still influence the new system, which I guess we're going to call LIT, local income tax. Though Tamara and I kind of like the idea of light. You know, the new system is going to shed light on how the local income taxes work and make them more transparent. But I suspect LIT is what we're going to end up calling this stuff. The County Income Tax Council, for those of you who've for those of you who either never used it or used it long, long ago when COIT was first adopted, it's made up of the fiscal bodies of the county, the cities, and the towns within the county, and the votes are allocated based on population shares, with the county representing the population in unincorporated areas. And in effect, what this means is that if there is a big city in your county, that city may very well have the majority of votes on the County Income Tax Council, and in casting their votes for whatever is being proposed, would effectively control the decision. So the County Income Tax Council was invented with COIT to give big cities in some counties a little more leverage than they had under the CAGIT decision. But so that's still there, the County Income Tax Council, and it depends. If you had COIT before, they're the ones in charge now under LIT. A few more details about our income taxes. The tax is paid on Indiana adjusted gross income, same as the state income tax. It's paid mostly from withholding from paychecks. The taxpayer Indiana income tax form includes a local income tax payment and refund, and you know, in the old days at least, you'd thumb through the booklet there, and you'd come to the page that listed the tax rates for all 92 or for all the counties, and you'd run your finger down there and say, "Is my county got the local option income tax?" And if it didn't, you'd breathe a sigh of relief, and if it did, you'd realize you had more tax to pay. You don't have to do that anymore because now all 92 counties have local income taxes, so that is no longer an issue, and you just have to figure out what your rate is. But it's paid along with the state income tax. Here's something of a change. It used to be that out-of-state taxpayers for some of our CAGIT, COIT, EDIT would pay a fractional rate, a rate that was some fraction of what the resident taxpayers were paying. Some of the taxes were like that and some of them are not. Under the new LIT, we've consolidated that, and all out-of-state taxpayers will pay the same rates as county residents. Now, this idea originally came about with CAGIT way back in the 70s, when it was thought that if you make people who work in your county but live somewhere else pay a fraction of the tax to the county where they work, and if enough people are working in the county and paying the tax, it would encourage the counties of residents to adopt the tax. And so for a while, there were quite a number of counties that did not have local income taxes, and if their residents worked in a county that did have the local income taxes, they would be paying taxes to a county where they worked and not where they lived, and that meant that counties had a little bit more incentive to adopt. Well, eventually all 92 counties have it, so this only applies now to out-of-state taxpayers who work in Indiana. The revenue is collected by the Indiana Department of Revenue, and then it's distributed back to the counties. All of the money is supposed to be distributed, although the Department of Revenue will keep a balance in each county's account of about 15% of distributions. And when that amount goes above 15%, they will distribute any excess that accumulates. And then once it arrives in the county auditor sees the distribution among the local government units. And then how do you know how much you're going to get, and how are you going to budget with the local income taxes? The state budget agency notifies the counties by August 2nd of their total LIT distribution. This is called the certified distribution for the coming year. So as of beginning of August this year, the notice went out, and the state budget agency published a list of the amount of revenue that was going to be distributed to each county, and they based that number on the revenue collections up to that point from the previous year. So all the revenue does get distributed. This has also been an issue, or at least under the law, all the revenue is supposed to be distributed back from the state out to the counties. Okay, now let's talk about the details and how we are consolidating these income taxes into one big tax. Excuse me. Okay, first of all, there will be a property tax relief rate. So there is one big local income tax rate now, but there are sort of subsets of rates that have different purposes. And the maximum rate for property tax relief is 1.25%, 1.25%. The purpose of that is to reduce property taxes with tax bill credits for homesteads, other residential property, farmland, business and equipment, and any combination. And credit percentages can vary by property type. So what happens here is you decide who's going to get the tax relief, right? And you've got basically four categories that you can use. You can give the money, you can give the tax relief entirely to homesteads. And so what you do is you've got your income tax rate, and the revenue comes in from the income tax, and then you figure out how much homesteads are paying in tax bills, and you divide the income tax by the amount that homeowners are paying by tax bills, and you say that's the percentage reduction that every homeowner is going to get. So you can give the tax relief entirely to homesteads if you want to. You can give the tax relief to folks in the 2% category of the property tax caps, of the circuit breaker tax. And this is new, actually. This is something that's been added with the local income taxes. And the 2% category, as you may know, is non-homestead residential property, so rental housing and second homes and apartment houses and things like that, places where people live that are not owner-occupied residences, primary residences. And it includes farmland. The 2% category includes farmland. And so this is an increase in flexibility. I said I'd identify some increases in flexibility. It used to be if you wanted to give farmland property tax relief with the local income taxes, you had to give the tax relief to everyone. That is, all business property would receive the tax relief. Now you can give property tax relief to farmland if you also give it to rental housing and second homes. And so that's something new. That's a category that we did not have before. Third category of property tax relief is all residential, including homesteads. So you can say, if you want to, in a sense, exclude farmland and just give it to residential, you can do that. So that would be rental housing, homesteads, second homes, apartment houses, and so forth. And then the fourth category is the 3% category in the tax caps, and that's business, personal, and real property, business land, buildings, and business equipment. And you can do it in any combination. So you've got that 4 different categories. You can do any combination if you want. If you wanted to give part of the credit to homesteads and part of it to residential and part of it to business and part of it to residential plus farmland, you can do that as well. And that's an increase in flexibility. There are more categories of tax relief and more combinations of property tax relief available now than there were before. Distribution, how do you do this? Well, as I described, you figure out the tax credit percentages. What happens is each taxpayer then reduces their property tax bill by that credit percentage. That is lost revenue for all the local governments to which that taxpayer pays. So the county and the township and the school corporation and the city or town, if they're in a city or town, would lose that revenue. And then that revenue is replaced by the local income tax revenue. So the distribution is based on who gets the tax base and in which units do they live. Okay, so that's the tax relief, and as I said, the maximum rate 1 1/4% for property tax relief. And then there are several expenditure rates, and so we're going to list the several categories of expenditure here on the next several charts. And the maximum rate for expenditures is 2.5%, and it's 2 3/4 in Marion County, Indianapolis there. And that means that the total maximum for everybody but Marion is the 1.25% for property tax relief, plus the 2.5% for the expenditure rates, or 3.75%, 4% in Marion. Now, you know, nobody has ever gone that high. This is really not an increase in the maximum rate. If you had adopted all of the other taxes that had existed before in just the right combination, you could have gotten the rate up to 3.75. As far as I know, nobody's ever gone above about 3.1, but it's possible, and now that is made quite clear. Before you really would have had to kind of research what would be the maximum rate if you arranged everything just right. And now we know the maximum rate is 3.75%, so a little bit more transparent right there. So the expenditure rates are added revenue for local government expenditures for various purposes, and the distribution among the local units of government, the county, the cities and towns, and then the other units as well, depends on the purpose of expenditures, and so we'll talk about that as we go forward. First of all, the first expenditure category, and I'm going to call those allocations. All right, so we've got rates and we've got allocations. I'm not exactly sure how the vocabulary is going to fall out on this, but as I read it right now, the word allocation seems like it might be a word that is selected for this. But so we'll say you've got a rate of something up to 2.5%. You've collected the revenue. How will it be allocated? What is the allocation? And one possibility is allocation for public safety. Now remember, before we had a public safety local income tax with a maximum rate of 0.25%. And so here's another increase in flexibility. You are no longer limited to 0.25% for the public safety rate. In fact, you could, if you wanted to, increase your public safety rate to 2.5%, 10 times what the old maximum was. Really don't think anybody's going to try that, but you could do it, right? It's an increase in flexibility. And what it does mean that if 0.25% was not enough for you and you wanted to go to 0.3 or 0.4 or 0.5, now that's a possibility as well. Notice as well that at least originally, in order to adopt the public safety rate, you had to adopt one of the property tax relief LOIDs, one of the property tax relief income taxes. That is not true anymore. Now these two decisions are completely separate. You can have property tax relief without the public safety, you can have the public safety without the property tax relief, or you can have both. They are independent decisions. As I said, maximum public safety rate is in a sense 2.5%, but the total maximum of all the expenditure rates is 2.5. So if you've got other expenditure rates, you couldn't raise public safety all the way up to 2.5. So the sum of all the expenditure rates has to be under 2.5%. And the purpose of the public safety rate is the same as with the old public safety LOIT. It's additional revenue for police and law enforcement, fire protection, corrections, emergency medical communications, and other public safety functions. Could be general expenditures, could be capital expenditures, could be pensions. Basically anything that can be classified as public safety, you can use this revenue for. County, cities, and towns are the main recipients of the public safety expenditures, although by ordinance, the county council or the county income tax council could include other units like the fire protection districts or even the townships that do volunteer fire departments or professional fire departments if the townships have such things. Those could be included as well if they're included in the ordinance. If you do include those folks in the ordinance, then you have to identify how much money they're going to get, and they get that money off the top. And then the rest of it is distributed by formula, which is based on a modified version of shares in the total property tax levy. And this goes all the way back to Cadgett originally. The money was simply distributed based on the percentages of each unit in the total property tax levy. But we've had so many modifications in the way we've done property taxes since 1973 that now we don't call it levy anymore. But basically it starts with the levy, we do all the modifications, and then that's the share that you get. So that's done by formula once the decision is made. So that's public safety expenditure. Next kind of expenditure is for economic development, and this is the descendant of the county economic development income tax. And again, it's under the expenditure maximum. So the seated maximums were, what were they? One half of 1%, I guess, which depending on what other kind of tax you had. And so now the maximum is basically 2.5%, depending on what else you're doing with the expenditure rate. So again, another increase in flexibility. The economic development portion, allocation, is additional revenue for economic development to promote employment or retain, expand, or attract new business. And it is distributed to cities, counties, and towns. And in order to receive the revenue, you have to have a capital improvement plan. And so that's one of the, that's an additional requirement that is not true of the other allocations under the expenditure rate, but that was always true under seated. So economic development still a possibility, even under the new lit tax. Last couple of expenditure allocations. we're going to keep the phrase certified shares. That was a phrase that came out of CAGIT originally. So the certified distribution was the total amount of revenue that came from the state to the county, and then the certified share was the spendable amount after tax relief that got divvied up among the local units. I kind of hoped that they would have eliminated that phrasing because it doesn't really tell you anything if you don't know the jargon. I think if we had just called it general expenditure, that might have done the trick. But it says certified shares right there in the law, so that's what we're going to call it. But that's what it is general expenditure. And so again, it's under the expenditure maximum of 2.5%, and it is additional revenue for general purposes, and it's distributed to all the civil taxing units, which means everybody but the school corporations. Now, the school corporations in CAGIT counties will still share in some revenue, as they always have, and I'll get to that here in a minute, but any new lit money here is distributed to the civil taxing units, not the school corporations. As for general purposes, you can use it for anything that you want. Then the last category of expenditure allocations is special purposes, and these are all of the rates that were set by special legislation. So over the years, counties have gotten the state legislature to say such and such a county is authorized to levy a local income tax rate for this particular purpose. A lot of times it was for construction of public buildings. A lot of jails were built or are being built and funded with these local income taxes. And so, you know, the point of LIT was to simply make the old system, simplify it, consolidate, make it more transparent, not to change anything that had been passed before. So all of the special legislation, local income taxes that have ever been passed are still in effect, and they are just part of the expenditure rate under that maximum rate of 2.5%. So the purpose identified in the special legislation by the General Assembly, same purpose as before, and the units that receive the distribution are the ones that are identified in the legislation. So there you go. That's how it works. And once again, the greater flexibility, I think. The rate limits are much looser. We've got one maximum 2.5% rate rather than several different subsets of rates. You don't have to adopt the tax relief, property tax relief rates in order to use the expenditure rates. Those connections are severed. Simplification and transparency. Now, the old system is still going to exert some influence on the new system, so let me show you a few of those. About, what was it? I think 11 or 12 counties adopted that LOIT, the levy-freeze LOIT. And it was back in 2007. Originally, in order to have the public safety tax, you had to adopt both the property tax replacement and levy-freeze LOIT rates. And so a number of counties adopted those originally. Once that was removed, the levy-freeze was not adopted by very many more counties. It was extremely hard to explain and hard to understand as well, and I'm not sure any of us ever fully understood that. Well, okay, it's gone as an option. The levy-freeze option is gone, but the freeze rate, and the idea was here to freeze the property tax levy for a year or two and then say, well, any increase that would have happened in the levy will be replaced by a local income tax rate. Well, that levy-freeze local income tax rate will be included as an expenditure rate, and since it was levy-freeze, it will be included as one of the general expenditure rates as part of the certified share. As I said, the levy-freeze option, though, no longer available, and thank goodness for that, because it was just a mess to try to understand that. For counties that had the county adjusted gross income tax, now originally back in 1973 when CAGIT was first adopted and continuing up to the very end of the CAGIT years, which are basically now, schools shared in the first 1/4% of CAGIT, and that was intended for property tax relief. But what happened was we reduced the school's property tax levy and simply replaced it with local income taxes. And rather than trying to engineer the law to reverse that and to raise the school property taxes and in order to replace what they lost out of CAGIT, they just said, all right, we'll take 1/4 of 1% of the expenditure rate will be allocated to school corporations and all the civil taxing units. So that first 1/4 of 1% of the expenditure rate in formerly Cadgett counties will be divvied up, including the schools, and then the rest of it will be divvied up, not including the schools. And in that way, the schools continue to receive at least something like what they had received before. In the first year, they will receive just what they would have received before. After that, after the levy freeze amount and after the school amount out of Cadgett, everything remaining is going to be called additional revenue. And it'll be additional revenue under the expenditure rate. So basically, you've got your expenditure rate, you're going to allocate the levy freeze amount, you're going to allocate the Cadgett 1/4% including schools, and then everything else gets allocated to public safety or economic development or certified shares for general purposes and divvied up as the law requires. Well, is this simplification or is it not? It's certainly, I think, an increase in flexibility, as I've said. Maybe you see it as an increase in transparency. In a sense, it is not simplification because the fact of additional flexibility means there are more decisions to make. There are fewer limits placed on what county councils and county income tax councils can do. And in a sense, that makes things more complicated. There are more options, more decisions to make, more options to consider. But here's at least some evidence that simplification will be achieved. What I've got pictured on your screen right there are miniatures of the pages from the state budget agency's local income tax distribution amount. That is that thing that they have to put out by the beginning of August, telling the counties how much revenue they're going to receive in the coming calendar year. In 2016, the last year under the old system, it took 11 pages to tell the counties how much they were going to receive. In 2017, it took only 5 pages to distribute that. And that's because in 2016, you had to tell them how much they were going to receive from Cadgett and how much they were going to receive from Coit and how much they were going to receive from CEDIT. In 2017, it was just how much are you going to receive from the LOIT, or from the LIT, from the local income tax, and then what the allocations will be. So simplification in that sense takes a little bit less verbiage and a smaller spreadsheet in order to get the job done. Whether this becomes simplification or not as we go forward remains to be seen. And I think the most interesting thing from my point of view anyway will be to watch whether or not the increase in flexibility causes the counties and the county councils and the county income tax councils to re-examine what their rates are and what their allocations are and say, you know, the old limitations are off and we'd really like to have more of this and less of that, or we'd really like to change the allocation of property tax relief. We'd really like to have more general and less public safety, or more general and less income tax, or less economic development, or vice versa, or we'd like to have more property tax relief and less expenditure, all sorts of possibilities that open up now that were not true before. And will the existence of this greater flexibility and these additional decisions that can be made, will that cause a re-examination of how our local income taxes are structured? Will we see activity on the local income tax front in 2017 and 2018. That's what I'm going to be watching for, so we'll see what happens. Okay, well, that's what I have to say about the local income taxes. Let's talk about farmland assessment. And this is quite the story, and we are making quite the change that's going to have an impact on farmland owners in particular, but rural local governments and rural taxpayers in general as well. Let me back up to the very beginning and give those of you who are not current on this issue a little information about how assessment of farmland works. Now, farmland is the only major category of property that we do not attempt to assess based on market value. We don't look at selling prices for farmland. Instead, we use a capitalization formula for farmland. It's called use value assessment. And the idea there is that we're going to assess farmland based on its use as farmland and not based on any other use that it could be put to. Because, you know, farmland that's just on the outskirts of a city, for example, or is right next to a new housing development, could be considered to be worth more as for commercial development or residential development, and might be valued in the market on that basis. Instead, what we're going to do here, and what we have always done, and what most states do, is to value it on how much, what it is worth in terms of producing corn and soybeans. And so we do that using a capitalization formula. And it's a three-step process. We start with what's called the base rate, and the base rate is calculated each year by the Department of Local Government Finance, the DLGF, based on rents and yields and commodity prices and costs and interest rates. And I'll give you a table here in just a sec to show you how that works. So we take all of that data and we put it into a capitalization formula, and we come up with one statewide 4-digit dollar figure as the starting point for the assessed value of all the acreage in Indiana. Of course, some acreage is worth more than others, depending in part on how much corn you can grow on the land. Some soil is very good and some soil is not so hot. And the soil productivity factor is then multiplied by the base rate for each acre of farmland. Productivity factors vary from 0.5, as 1/2, to 1.28. So you multiply that number by the original base rate, and you then get a variety where more productive farmland is valued higher and less productive farmland is valued lower. And then for some acreage, we subtract an influence factor, which is a percentage reduction, which says, you know, even if the soil is good, there might be some reason why you can't grow much corn on that land. For example, it floods frequently. That would reduce its productivity, or it's covered with trees. That would reduce its productivity as well. So there are several different influence factors, percentage reductions that can happen for some acreage. Most acreage doesn't have this, but some of it has some influence factors. So the base rate times the soil productivity factor less the influence factor is how we determine the assessed value of farmland. And then you multiply that by the tax rate where the farmland is located, and the tax rate, of course, the sum of the county and the township and the school corporation and the library district and special districts, and occasionally the farmland's actually within the boundaries of a city or town, and they pay that rate too, subject to the tax cap of 2% of the value of farmland. So that's how we do it. We're going to change the way we do the assessment of farmland. Why? Well, here's an illustration as to why this issue came up and what the problem was from the point of view of farmland owners. And what we have here is a table that shows the basics of the calculation for how the DLGF calculated the base rate for taxes in 2014. Now, you see up there it says 2013 paid 2014. Taxes in 2014 are based on assessments in 2013. And so that's how we always say it, 2013 pay 14. And it was, and this is the old formula, the old capitalization formula. We took 6 years of data, and the data you'll see for pay 2014 was from 2005 to 2010. And for each of the years, we take the cash rent, that is the average rent that is collected on an acre of land, an average acre of land, and this is derived from a survey that our own Department of Agricultural Economics does every year. So you take the average cash rent per acre, and then you take an operating income, and that's calculated with a rather complex sequence of numbers, but it's basically the price of corn and beans times the yield of corn and beans for that year, so the prices that year and the yield that year, how much was grown per acre, minus the costs, and you get then the amount earned by an owner-operator per acre based on the yield and the costs and the prices of crops that year. So as you can see, if we do 2005, it was $110 in cash rent and $59 per acre operating cost. Then you take a capitalization rate, and the capitalization rate is based on a couple of farm interest rates that the Chicago Federal Reserve publishes. And so it's a home loan rate and an operating rate. And you take the average of those two, and it was 7.22% in 2005. And then you divide the cash rent by the capitalization rate, and you divide the operating net income by the capitalization rate, and you get what's called the market value in use. And for cash rent, $15.24, and for operating, $8.17 there in 2005. And that's the capitalization formula idea The idea is that a rational investor would pay $1,524 in order to get an asset that yielded $110 in rent if an alternative investment could give them 7.22%. Or in other words, if you can earn 7.22% on an investment, you wouldn't pay anything more than $1,524 for an asset that yielded $110. And so that's the capitalization formula idea. And then take the average of the cash rent and the operating calculations, and as you can see, it's $1,170 for 2005. And then you do that for 6 years, 2005 through 2010. You drop the highest year, and that's why 2010 is crossed out. You see its average was 2621, and so the highest year is dropped out. And the remaining 5 are averaged together, and the base rate in pay 2014 was $1,760. And that would be the number that you would then multiply by the productivity index, subtract the influence factor, then multiplying that result by the tax rate, and that would give the tax bill for the farmland owner. Now, the next year, the base rate is, or was, is, and still will be, modified every year based on new data. And since this is 6 years of data, what happens in 2015 is we will add in the year 2011 and drop out the year 2005. And so here it is. And so what happens? 2006 has dropped out, and 2011 has been added in. But as it turned out, 2011 was now the highest rate. And so that 36.99, the highest average, the 36.99, gets crossed out, which means effectively the 2010 number, which had been crossed out before, is now included. So what happened here? Well, if I can go back here, you'll notice in 2005 the average was 1170. In 2010, the number that's added in is 2621. So we dropped out 1170 from the 5 years that are included in the average, and we added in the number 2621. Well, we added in a number a lot higher than the one we dropped out, and that pushed the average base rate up to $2,050 for pay 2015, which was an increase of 16.4%. And what was happening was the base rate was increasing by quite a bit, numbers like 16.4%, between 10 and 20% a year, for quite some time. And the reason, and you can see it on this list here, the reason is that operating incomes were beginning to rise starting in 2006, 2007. Cash rents were starting to rise. The reason for that was corn prices had gone up. Soybean prices had gone up, and the reasons for that had to do with increases in oil prices, and so using corn for ethanol increased the demand for corn, and the demand coming out of China and other developing countries that were growing great guns during this period was increasing the prices of commodities. And there was a kind of, heard it described as a kind of golden age of agriculture from about 2006-07 through about 2013-14. Corn prices and bean prices were really quite high. And then the other thing that was happening was the capitalization rate was falling, right? Interest rates were falling. And the immediate cause of that, of course, was the recession and the Federal Reserve's response to the recession, cutting interest rates so that all interest rates fell. So what you had was increases in the net incomes because of rising corn and bean prices and a falling capitalization rate. The numerator was increasing, the denominator was decreasing, the market value and use figures were increasing quite a bit, and so you can see those averages there between 2006 and 2011. The average market value and use more than tripled. So the numbers that were being added in were a whole lot more than the numbers that were being subtracted. And before I move on from this table, I do also want to point out that for pay 2015, under the old capitalization rate, the data that was used was from 2006 through 2011, which means there was a 4-year lag between the base rate used to calculate property taxes for 2015 and the data that was actually used in calculating the base rate. A 4-year lag. Now, it doesn't have to be a 4-year lag. We could have a 2-year lag. When they were calculating this base rate, they were calculating it early in 2014, they already knew the data for 2012, and they already knew almost all the data for 2013. So the 4-year lag is something that was not a necessity. It developed out of the delay that happened in the reassessment in the early 2000s after the town of St. John's case kind of messed up the system for property taxes and assessments, and it took us a while to get it back together again. And this gap opened up, this 4-year lag opened up, and that's going to play a role in the story that we tell about the policy change that we're making. Okay, so here's a picture of what happened to the base rate from 1980 all the way up to 2016, or what it would have been in 2016, and then beyond that. And because of the 4-year lag, you could always make really good predictions about what was going to happen. You know, for the year 2016, for example, the data was used in calculating the 2016's number was only current through 2012. If we already knew 2013's and 2014's data, we could run it through the formula and get a projection of what the base rate would be for 2017 and 2018. And so when you see up there a projection beyond that line for 2018 and even 2019, those are really good projections. We knew what was going to happen under the old capitalization formula. And what you see is a number of the policy changes back between 1980 and 2002, before the town of St. John's pushed us to market value, or at least to objective measures of property wealth. We had a negotiated rate. Farm interests and the old tax board would get together and work out a base rate. Capitalization formula introduced as a result of the town of St. John's case in 2003, and the value of the base rate jumped, as you can see there. But it went down once we started with trending. When we decided to update the base rate and all the other assessed values every year. At that point, the base rate actually went down to $880, and it was $880 in 2007. By 2014, it was already up to $1,760, and exactly doubled from 2007 to 2014. So over 7 years, it doubled. Beyond that, under the old formula, was going to top $3,000 as of 2018. And again, we can say that with certainty. Had we fed the numbers that we knew through the formula that we knew it was going to go up over 3,000. Well, it was the golden age of agriculture. Okay, so ag property taxes were rising. They went up about 60% from 2007 through 2015. At a time when other property taxes were actually going down in total, especially homeowner property taxes. So farmland owners were paying a whole lot more in property taxes, but they were earning a whole lot more because corn prices were high and bean prices were high. Farm incomes were up. It was a golden age. But the golden age came to an end around 2014 or so, and between 2014 and the end of the decade, incomes were projected to be down. But because of the 4-year lag and the 6 years of data used in the formula, property taxes were going to continue to rise all the way out to 2019. So we were going to have half a decade of low and falling farm incomes and rising property taxes. And as you can imagine, the farm interests and the legislators who pay attention to farm interests, and that's most of them, were pretty concerned about this. And you know, we knew for years actually that once commodity prices declined, we would face this situation, just given the way the formula was structured. And it came to pass in the second half of this decade, or at least it threatened to come to pass in the second half of this decade, but for Senate Bill 308, passed earlier this year. And Senate Bill 308 makes 2 major changes in the farmland base rate formula. They are changes that are going to, in fact, reverse what would have happened to the base rate, and instead of allowing it to continue to rise, it's actually going to make the base rate fall. First thing they did was to eliminate the 4-year lag, and what that means, instead of using data from 2008 to 2013 to calculate the 2017 base rate, we're going to use data from 2010 to 2015. So we're going to use the most recent data available, and in some cases having to make some estimates about what those are, because there are a couple of data points that are not quite available when the base rate is calculated. But for the most part, you've got all the data that you need in order to do a 2-year lag. So reduce the 4-year lag to a 2-year lag. Second, we're going to stabilize fluctuations in the base rate by adjusting the capitalization rate in the denominator of the formula. And this is where it starts to get a little more complicated to explain what's going on. So here's what's going to be done. We're going to calculate for each year. We're going to do a two-step process. We're going to calculate what will be called a preliminary base rate using the old capitalization formula with a 2-year lag. So that means for 2017, we'll use the data from 2010 to 2015. We'll cross out the highest number, and we'll average the rest. And we'll do that with a 2-year lag, and we're going to calculate that preliminary base rate just like we did with the old capitalization formula, only with a 2-year lag. And then we're going to compare the preliminary base rate to the existing base rate. And if the preliminary rate is greater than the existing base rate by more than 10%, then we will replace the capitalization rates, those interest rates, in the 6 years of the capitalization formula with 8%. Now, 8% is a high rate. And so what it says is, if the preliminary rate says that the base rate is going to rise, we will lessen that increase by increasing the denominator of the capitalization formula, by putting 8% in the denominator of the capitalization formula. If the preliminary rate is less than the existing base rate by 10% or more, that is, if the preliminary rate shows that the base rate should be falling, then we will reduce the rate of decrease by putting a small capitalization rate in the denominator of only 6%. If you put a small number in the denominator, then the whole calculation is bigger, which means the decline in the base rate will be lessened. So in each case, if the preliminary rate is rising, if the base rate is going to go up, we'll make it go up less by adjusting the denominator of the capitalization formula. And if the base rate is going to go down, we'll make it go down less by adjusting the denominator of the capitalization formula. And if the preliminary base rate is within that plus or minus 10% range, we use 7%, which is kind of an intermediate rate, and it says, well, if it looks like it's going to stay stable, we'll let it stay stable. So this is, you know, I've been kind of joking that what we're doing here is adjusting an important factor of the farm economy by adjusting interest rates, kind of like what the Federal Reserve does with our great big economy. The DLGF now becomes a small Federal Reserve, and if Ben Bernanke isn't doing anything these days, maybe the next time we need a new head of the DLGF, we can hire Ben and he'll get this immediately as to what we're doing. But that's what we're doing. We're going to adjust the capitalization rates in the denominator of the capitalization formula in order to stabilize fluctuations in the base rate, or at least that's what we intend to do. And whether that's going to happen or not, well, that's some research Tamara and I have done, and we'll give you some ideas about that as we move along. But let me, I think probably having just described that, I need to show you exactly how this works. And this is actually the calculation that the DLGF did. First time they had to use this thing. They calculated the 2016 pay 2017 base rate. So we already know what the base rate is going to be for taxes in 2017. It's always calculated at the beginning of the previous year. So at the beginning of 2016, this year, they calculated the preliminary and final base rate so that we'd have it available for the calculation of property taxes for taxes in 2017. So here's what the formula looks like, and you'll notice it includes the years 2010 through 2015. So as of early 2016, the 2015 data was the most recent data available. And we crossed out 2013, which came in at 5,640, which was a real anomaly. That was by far the highest market value in use we've ever seen. And it resulted from commodity prices that were still being influenced by the drought of 2012, so those commodity prices were high, and the yields in 2013, which were the recovery from the drought. So you had a high yield and a high price at the same time, and we wound up with this very large average. But it gets crossed out of the formula, so it will never actually enter into the base rate. Well, we do the calculation as usual, and you notice the cap rates there in red are ranging from 4.74 in 2015 to 5.97 in 2010, so very low cap rates compared to what we had seen before. You can see the cash rent and operating, but notice cash rent peaks in 2014 is now starting down. And notice operating income peaks in 2013 and is starting down, and in fact calculated as negative in 2015. So 2015, not a very good year to be a farmer, not a good year for farm incomes. Commodity prices fell quite a bit, and costs exceeded the yield times the price in 2015. So with commodity prices falling, rents will go down since it's simply not as profitable to rent land. The earnings on land is less, and so the rents are starting to go down, and the operating income down as well. When you average those together, you get 1677, as you can see. So signs already showing up in the calculation that the farm economy has taken a turn for the worse and that the golden age is over. You take those 5 numbers and you average them together, and there's your base rate of 29.87, and that would round off to 29.90, and that's that near 3,000 base rate that we would have seen in 2019 under the old formula, right? Because the data from 2010 to 2015 under the old formula would have been used for the base rate in 2019 with the 4-year lag. But now it is the preliminary base rate for 2017. Next step, we compare that 29.87 to the existing base rate, and the existing base rate is 2050. Our previous legislation had frozen it at 2050 while we held the hearings last summer, this past summer, in order to try to figure out what to do with the base rate of farmland. And so we're comparing the 29.87 to the 2050, and it's up by 45.7%. The preliminary rate is way more than the existing base rate. And what that means is we're going to use a high capitalization rate in the calculation. And here's what that looks like. Right, there it is. There's all those 8%. We've replaced the cap rates with 8%. We'll take a look at what those cap rates were, right? They ranged from 4.7 to almost 6. And now we're going to replace them with 8s. And if you put a much bigger number in the denominator than you had before, the averages, the market value, and use the capitalized values are going to be much lower. So you see the cash rent and the operating numbers are the same. We're just using a higher capitalization rate, and that brings those averages down. Well, you know, the thought was, I think, that, hey, the base rate is trying to pull, or excuse me, the preliminary base rate is trying to pull the base rate upward, and so we'll put higher cap rates in there so that it doesn't go up as much. Well, the cap rates turn out to be so much higher, the 8% is so much higher than the cap rates that actually exist, and in fact, the base rate is going down. It was 2050, and now it's going to be 1960, and that is the rate that has been established for taxes payable in 2017, and that's a 4% decrease in the base rate, and it's the first decrease in the base rate since 2007, since it went down to 880 with the original introduction of trending. So it's been a long time since the base rate went down, but now it is going to go down, and that will mean tax bill reductions for most farmland owners. Now, a 4% decline in your assessed value could easily be overwhelmed by an increase in tax rates, and that will happen for some farmers. But an awful lot of farmland owners will see reductions in their property taxes in 2017 because of this decline in the base rate. So that's what's going to happen in 2017. What's going to happen after that? And this is where I regret the elimination of the 4-year lag, because in the old days, under the old capitalization formula with a 4-year lag, every January, I would be able to take the data that I knew, right, 2 years of data that were already in the books that had not been used in the base rate calculation, and I could run those 2 years of data through the formula, and I could make a 2-year in advance prediction of what the base rate would be, and it was almost always within plus or minus 20 bucks. And it made me look great. As an economist, anytime you can make a prediction that accurate, well, that's quite exceptional for economics. But you could do it because you knew the data, you knew the formula, you ran the data through the formula, and there it was. Right? And sometimes there were data revisions, little data revisions, and you'd have to make an adjustment. But you could really get accurate. Well, those days are gone. Now that we have a 2-year lag, I don't know any more data than the DLGF does in making their calculations of the base rate, and so we have to take a look at forecasts of what's going to happen in the farm economy and what's going to happen to interest rates. And here are some of the data that we used, and this is let me give credit where credit is due here. Tamara Ogle knows way more about agriculture than I do. I'm a property tax local government guy, but she knows this farm stuff, and so she found some authoritative data projecting what will happen in the farm economy. It comes from an organization at the University of Missouri called FAPRI, which stands for Food and Ag Policy Research Institute, and they do 10-year baseline projections for U.S. agriculture. And so if you take a look at the corn price and the soybean price there, I've got 2015, the actual numbers for 2015, projections through 2018, and then just to save space, jumping ahead to 2025, which is the last year of their 10-year projection. And what you see is corn prices bouncing around a little bit under $4. Occasionally in the early 2020s, it's above $4. So approximately $4 corn is what they're looking for. And you see the soybean prices there bouncing around in the 9s for the most part, but by 2025, almost 10. So if you want a rule of thumb here, it's $4 corn and $10 beans, and that's price per bushel for corn and soybeans. So that's what FAPRI is projecting on out through 2025. As far as yields are concerned, you see the corn yield and the soybean yield there. Trend increases, right? 10% increase in soybean yield from 2015 to 2025, and more like a 20% increase in corn yield for 2015 to 2025 from 115 to 183. So the gradual trend increases in the yields, and this is, you know, a long historical trend going all the way back to at least the 1930s. Yields have been increasing since then. Variable costs, the costs of labor and fertilizer and seed and all that stuff. Variable costs rising basically with inflation, a little bit less than the inflation rate probably. Property taxes going down because the base rate is going to fall, and that's a calculation, of course, that FAPRI doesn't do, but that we estimated based on what the DLGF has done in the past. Same thing with cash rent going back all the way to the top. That was an estimate done in-house here by Michael Langemeyer based on the expectations of what will happen to prices and yields and operating profits and stuff like that. So we think cash rents are going to fall as the rents adjust to the lower prices of corn and soybeans and the lower incomes that farmers will be earning from selling those crops. Getting back down to overhead costs, less property taxes, those rising as well with inflation. Government payments, that's tough because there's going to be a new farm bill. In fact, there will probably be 2 new farm bills over this period out in the next 10 years. And it's very hard to know what the Congress is going to do with the farm bill. So some sensible estimates there. FAPRI thinks a decline. And then the capitalization rate. And the capitalization rate is one that FAPRI doesn't do. I did that. And the only folks that I know of who do 10-year projections of interest rates is the Congressional Budget Office, working for the U.S. Congress. And they do a 10-year projection of the Treasury rate, actually the 10-year Treasury rate, the long-term Treasury rate. And that one is correlated with the farm property tax rates, really closely correlated with those farm property tax rates. But the farm interest rates. And those farm interest rates are about 2.9 percentage points higher than the Treasury rate over the last 20 years. You take the average over the last 20 years, and that's been true. So all I did was to take the CBO Treasury projection and add 2.9. And what we come up with is that the capitalization rate goes up to about 6.5% by 2022. The Treasury rate that the CBO is projecting hits 3.6 by 2022 and then stays there. And so I've got the capitalization rate at 6.5% out in 2022 all the way out to 2025. And that reveals, I think, something that's important to know about these projections. These are trend projections. There is absolutely no doubt that corn prices and bean prices and yields and interest rates and virtually everything here is going to bounce up and down around this trend. So some years the weather's going to be great and the yields will be higher and the prices will be lower. Other years the weather's going to be terrible and the prices will be higher and the yields will be lower. And so we don't, this is not a prediction that corn prices are going to stay stable at $4 per bushel all the way out to 2025. But it's what we think the average is going to be. What's the trend going to be? Likewise with the capitalization rate, the idea is that we may accelerate towards 6.5. We may top 6.5 for a while. It may take longer to get to 6.5. We really don't know, and it really depends on the business cycle and the actions of the Federal Reserve, among other things. But that's where the Congressional Budget Office thinks interest rates are headed. So let's be clear about that. We are not projecting an era of stability. We're simply saying where are we going to be? How we're going to bounce up and down around what averages, and that's what these represent. All right, let's take these numbers and run them through the formula and see what they imply about the base rate of farmland. And here's what it would look like under the old capitalization formula. And I've got 2018 marked off there with that solid line, so that's the first projected year. We know the 2017 number would have been 2420. Oh, excuse me, no, I misspeak there. This is the old capitalization formula, so we're basically saying with the 4-year lag, we actually know the numbers out through 2019, and then beyond that are our projections. And what you see is it peaks. We would have projected it to peak in 2018, still be about 3,000 or 2,990 in 2019. And then the lower corn and bean prices and the rising interest rates that we expect to see would have started to kick in to the old formula with the 4-year lag, and the old capitalization formula would have brought the base rate down. And by 2023, we'd be down to about 1,600 in that neighborhood, and that's where it would stay. Now, we're not saying it would have stayed at 1,600, but we're saying with our projections of average rates, the average, we would have bounced up and down around 1,600 under the old capitalization formula. So that's what it would have happened, and what it shows is exceptionally high base rate in 2017, 2018, 2019, 2020, at a time when farmland or farm incomes were down. And that was the problem that the legislature wanted to address with this formula. Okay, let's take a look at the preliminary base rate, and there is the preliminary base rate calculation. So remember, the preliminary base rate calculation is the same as the old capitalization formula, only with a 2-year lag instead of 4-year lag. So what that dotted line is the old capitalization formula ratcheted left by 2 years. Right? So it runs parallel to the old capitalization formula, but it all happens 2 years earlier. And one problem with getting rid of the 4-year lag was that had we done it in 2017, it actually would have increased the farmland taxes, would have increased the base rate. We would have hit 3,000 in 2017 instead of 2018 had we done that early. But so we do it now, but we're making this other change as well. And so what you see there is the preliminary base rate and how it is related to the old capitalization formula, 2-year lag instead of 4-year lag. And now the final base rate in Senate Bill 308. And there it is. Okay, so we're at 2050, frozen under the law in 2015 and 2016. We see the number 1960 for 2017. And after that, we are looking at considerable reductions in the final base rate. And the reason for that is when you compare the preliminary base rate, in 2018, for example, preliminary base rate is actually 2818, right, about 2,800. And that is way higher than 1960. So you're going to compare the 2818 to the 1960. It's way more than 10% higher, so we're going to continue to use the 8% in the denominator, since the actual interest rates included in the preliminary base rate are in the 4, 5, 6% range. If we replace those numbers with 8% in the denominator, the final base rate ends up considerably below the preliminary base rate. And that turns out to be true as far as the eye can see, all the way out to 2027. Now, because of a 2-year lag, we've got the projections from FAPRI through 2025, so we can project the base rate through 2027. And through 2027, as you can see, we're projecting a base rate in the neighborhood of $1,200 to $1,300 all the way out to 2027. Now it starts to rise a little bit, as you can see, after it drops in 2021, 2022. It starts to rise a little bit, and that's a reflection of increases in yields. And so you would expect it to go up, but it goes up gradually, as you can see. But the main thing what you see up there is the big drop that occurs from now, basically, all the way out to 2021 and 2022. And those numbers in 2021 and 2022 are both $1,070, $1,070 would have been under the old capitalization formula in the neighborhood of $2,400 in 2021, so that is a big reduction, needless to say. Just about cutting the base rate in half from what it, or more than in half from what it would have been, and reducing it in the neighborhood of 40 to 50% from what it is now, 1960 down to 1070. And then out further on, what you see is the capitalization formula, the preliminary base rate, the preliminary base rate calculated using capitalization rates of 6.5%, always producing a number more than 10% higher than the previous year's base rate, and so always being replaced with 8%. And so the difference between the green line and the black dotted line that you see out there beyond 2021 is the fact that the projected interest rate based on the CBO's projections only gets up to 6.5, and the formula says we're going to use 8. And so we're always going to be using a capitalization rate higher than the actual capitalization rate, and so the final base rate is always about 20% lower than the preliminary base rate. And so what we're looking at really is, compared to the old capitalization formula, a permanent tax reduction for farmland owners. So what about the stabilization idea? Right? Wasn't this supposed to stabilize? Weren't we occasionally supposed to use 6% instead of 8% and sometimes use 7%? Well, what I did was a little experiment here, and I took the data that we've got for 1995 through 2015 and said, suppose we'd been using this new formula the whole time. Right? What would it have looked like? So basically I got 20 years worth of data on what prices and yields and costs and interest rates actually looked like, and we want to see, would this have been stabilizing had we used it over this whole period? And I think you can see that it would have been. Right? The green line there, which would have been the final, is actually greater, would have been actually greater than the preliminary base rate all the way up through from 2002 to 2008. And you can see across the bottom there the interest rates that are used in the denominator of the capitalization formula, because the preliminary base rate would have been trying to pull the final base rate down because it was lower than the final base rate. We would have been using lower interest rates, the 6% interest rate, cap rate in the denominator instead of the 8% rate. So that would have been stabilizing, right? And the final base rate would have been a little higher than the preliminary base rate. And then as the preliminary base rate went up with the declining interest rates and the rising crop prices, in 2009, 2010, it would have crossed over. For 1 year, we would have used 7, and then after that, we would have used 8. So there's the preliminary rate trying to pull the base rate up, and we're not letting it rise as much. So it's not as low as it would have been in the early part of the 2000s. It's not as high as it would have been after that. And so it performs a stabilizing role. When you take the average over this whole period, the average is 1536 compared to the preliminary rate of 1698. So the average is about 10% lower. So it's not just stabilization. There's also a bit of tax relief for farmland owners in here as well. But I hope you can see from this chart the idea that stabilization would happen with the change, with the new policy and what we do in the denominator of the capitalization rate. Here's the problem, though. Here are the real estate and operating interest rates on farm loans, the average of those two. That's the cap rate we use in the denominator of the capitalization formula. Here's what has happened to it since 1976, and then the projections out to 2025. And as you can see, we've had, since the early 1980s, a long-term trend decrease in the interest rates that have been used for farm activity. And this is certainly true of interest rates across the board. If you did mortgage rates, you'd see the same pattern. If you did state and local government bond rates, you'd see the same pattern. Corporate interest rates, treasury bond interest rates, all declining. Now, why has this happened, and why do we think it's going to continue to be low? Well, one of the reasons was the decline in inflation. We had double-digit inflation at the beginning of the 1980s, and now we're down in the 2% range or less. And so interest rates are set by lenders in order to earn a profit, but also to recoup the lost value of money as inflation occurs. So you would expect interest rates to be at least a little bit higher than inflation. So as inflation goes down, interest rates go down as well. And so certainly what happened in the 80s and the early 90s reflect the decline in inflation. But you know what? Since the middle 1990s, if you take out oil prices, the core rate of inflation, as it's called, has not varied more than 1 percentage point above or below 2%. We have had really stable inflation over the last 20 years, which means that there's been no decline in the inflation rate. And so the declines that you see in these interest rates since the mid-1990s must be due to some other cause. Now, you can't blame the Federal Reserve for that, because during that period, they were increasing rates at the end of the 90s and in the middle 2000s, and they were decreasing rates in the early 2000s and certainly after 2007. So the Fed's been up, the Fed's been down around this declining trend. So the declining trend is something the Fed is responding to, but is something that is coming from someplace else. So yes, the Federal Reserve has certainly had a good deal to do with our low interest rates right now, but this has been a trend that's been going on at least since the middle of the 1990s and maybe way back to the early 1980s, even apart from what's going on with inflation. Well, what's going on? Oh, I don't know. Couple of theories about what's going on. One of them has to do with the supply of loans, and one of them has to do with the demand for loans. This one's associated with actually associated with Ben Bernanke, the former head of the Federal Reserve. He said, hey, there's a global savings glut out there, so the supply of loans is really, really high right now. China is saving way more than they can invest. The oil countries are saving way more than they can invest. The folks in Japan are really dissatisfied with their low interest rates, and they're trying to invest all over the world as well. So you got this huge pool of money sloshing around the world looking for some rate of return somewhere. So with the really big supply of money to lend out there, the money's going begging, and so loan rates, interest rates are lower. And so that's one idea. That's an idea associated with Ben Bernanke, the savings glut. But there's another idea on the loan demand side, and this one's associated with a couple of guys, Lawrence Summers, former Secretary of the Treasury, and a guy named Robert Gordon, who's an economist up at Northwestern. And they think that loan demand is down, and the reason goes under the title of secular stagnation. And the idea there is that population growth is slowing down, so there are fewer people to sell products to, and technological advance and productivity is slowing down. Now, it's hard to see that given what's going on in electronics and communications and what's going on in, just a minute here. My phone just went off. I have to turn it off here. There we go. What's going on with loan demand, technological advance. You know, in entertainment and communications, we're seeing a whole bunch of technological advance, but elsewhere, not so much. And in fact, productivity has been declining over the last years. That is, the output per worker has actually been going down over the last years. And other than the last year, it's been growing very slowly for the last 10 years. So there aren't a whole lot of exciting new projects or products out there, or a whole lot of exciting new production processes for businesses to invest in. And with population growing more slowly, there's not a prospect of big increases in sales out there either. With the rest of the world growing more slowly, there's not a prospect of selling in the rest of the world. And so there's a thought that even with interest rates really low, businesses are simply not investing, and with this small loan demand, interest rates are low. So low loan demand, high loan supply, depressing interest rates. You know, which one of those is correct? You know, the argument is ongoing. I don't know that that either one has to be correct. It could be both, right? Two sides of the scissors, supply and demand, both seeming to push interest rates down. Well, what that means, if you look at that projection, is that interest rates are going to remain underneath or near the bottom of our low base rate formula minimum of 6%. And if they remain low, that means that the preliminary base rate will always come in high relative to the base rate, right? We're going to be calculating the preliminary base rate with interest rates like 6.5, and the final base rate will have calculated the year before with an interest rate of 8. And so we're always going to see the preliminary base rate higher by more than 10% than the existing final base rate, and that means we continue to use 8% in the denominator, which will continue to depress the base rate. And here are the projections of the base rate, and as you can see, final base rate always below the preliminary base rate by the end of this period by about 20%, and you can see the interest rates across the lower axis there. Would have started with 8 in 2010 and would have continued with 8 all the way out to 27. Of course, this is the experiment that we did, the simulation we did starting in 2022. But that's what we get, the result we get when we actually project forward, right? A final base rate about 20% lower than the preliminary base rate and about 20% lower than what the old capitalization would have produced out in the middle 2020s. Here are the numbers. I know some of you may have an interest in actually using the numbers, and if you did get a printout of the PowerPoint, I thought we'd put the numbers up there. And what you see with the old capitalization formula is the base rates settling in the 1600s. They're 1,600, and again, there would be variation as yields and prices and so forth vary, but that's the trend number. The preliminary base rate also in that same neighborhood of 1,600, and the difference between the two, of course, is the 2-year or the 4-year lag, and also the rounding off to the nearest 10 in the capitalization formula, but not in the preliminary. And then the final base rate, as you can see, about 20% lower based on the difference between the 8% capitalization rate used for the final base rate and the 6.5 used in the preliminary base rate. So there are your numbers. And take a look in particular, the decline from the current 1960 in 2017 by 2021 down to 1,070. And that's about a 45–48% decline in the base rate of farmland. So that'll be a tax reduction, and a sizable tax reduction for farmland owners. So they should be looking forward starting in 2018, 2019, 2020, 2021, they should be looking forward to some pretty considerable reductions in their property tax bills. But farmers aren't the only property taxpayers, are they? And so what happens? And what I've done here is a map which performs a simple experiment. It simply subtracts 48% from the farmland base rate and from farmland assessed value, and then calculates what will happen to property tax rates if, or what would have happened to property tax rates in 2015, most recent complete data I've got. So in 2015, if you had the same levy from all the same units, but a tax base, an assessed value, reduced, and reduced by 48%, by farmland reduced by 48%, that portion of the tax base reduced 48%, what would happen to tax rates? And the dark blue counties, and as you can see, those are mostly rural counties where farmland is a very important part of their tax base. Tax rates go up by 20% or more. The lighter blue, the bright blue there, 10 to 20%, again, mostly rural counties. And then the gray counties there are the more urban counties, or the counties that have other kinds of tax base and not as much farmland, have industrial or commercial or residential tax bases that kind of overwhelm the influence of farmland. So what does this imply? A tax rate increase in rural areas of 20% or more. First thing it implies is that taxes shift to all other taxpayers. So we're going to see a tax shift from agriculture to homeowners in rural places and other business owners in rural areas. And, you know, what do you say about that? Well, of course, the tax shift happened the other direction from 2007 to 2014. But from 2017 out to 2021, we should see a shift in the other direction. So we should see rural homeowner property taxes and rural business property taxes going up, especially in the dark counties that you see there. The other thing you might see is what happens to local government revenues under the tax caps. Now, you know, as tax rates go up, more and more taxpayers meet their tax caps and don't have to pay beyond that. So what we'll be saying is that here are some taxes, property taxes that farmers are paying, and they will get shifted to other taxpayers, but some of those other taxpayers will hit their caps and won't pay the full amount of the taxes that are trying to shift, and that would be revenue losses for local governments. So Some of the local governments that are in the darker blue counties will be vulnerable to revenue losses because of increased tax caps. Now, in most of the rural areas where most of the farmland is, the tax rates are well under $2, and so only the highest valued homes would wind up meeting their caps, and so the revenue losses may not be so great. But if you are a rural town that adds the town tax rate on top of the county school and township rates, those rates are frequently above $2 and in some cases even above $3, which means that the rental housing and the business property may already be at their caps or near their caps. And so I would think the units of government that are most vulnerable to revenue losses as a result of this over the next 5 years would be towns in rural areas where agriculture is important and school corporations that overlap those towns in counties where agriculture is important. Now, of course, the farmland isn't in the towns, but that doesn't matter for the tax caps, does it? Because what matters for the tax caps and the taxpayers in the towns is the total rate that they pay. So the town rate probably won't be affected because there's no farmland in the town, and so the rate doesn't change. But the county rate that those taxpayers pay goes up, and the school rate that those taxpayers pay goes up if it's a school rate that includes farmland just outside the town. Those rates go up, and so the folks in the town will meet their caps, and the local governments, the town governments, and the school governments that overlap the town, and of course counties as well, since they overlap the towns, they're the ones vulnerable for revenue losses. But particularly the town and the rural town school corporations, I think those are the ones that will have to be on the lookout for property tax revenue losses as a result of the change in the way we do the farmland base rate. You know, how will we know? When will we know? You know, in order to really figure this out, you need all the data. You need the data on the 3 million property parcels in Indiana. Legislative Services has that, and they will be coming out with projections. I'm not sure how long range the projections will be, but I think soon enough, maybe by the end of the year, we will see some projections for 2017, 2018, maybe out to 2019 to see what's going on. And at that point, we'll be able to see what the direction is, and in particular, which kinds of governments are actually vulnerable. But I think we can predict pretty well which kinds of governments are likely to be vulnerable as far as revenue losses, and which kinds of taxpayers are vulnerable as far as tax increases. For farmland owners, though, this should be a considerable reduction in their property taxes after many, many years of considerable increases in their property taxes. Well, that's what I have to say about local income taxes and farmland assessment. I want to, before we get away here, and we're going to take a pause and then come back for questions, and Tamara, I think, will be accumulating the questions, and she will communicate them to me in some way or other. But before we go, I did want to say and remind everybody who is on Twitter that we do have a Twitter account. It's InTaxRockstars. And we post information about state and local government and the economy of Indiana and other things about what's going on in our lives that relates to Indiana. For example, yesterday as I walked to my office here in the Krannert building, there was a giant 10-foot tall statue of Purdue Pete out back of the Krannert building, and I couldn't resist taking a picture of that and posting it on Twitter. So those are the sorts of things. One thing Tamara and I can promise you, I know if you follow Twitter, you'll know this, we promise not to mention either Donald Trump or Hillary Clinton in any of our Twitter posts. So if you want some relief on the Twitter stream from what has been the dominant conversation, please sign on to us, follow InTaxRockstars, and we will promise not to mention either of those people ever. So I'm going to mute my microphone here, and we'll be back in about 5 minutes, so that'll be at about 12:30, and answer any questions that you might have. So thanks very much for listening, and we'll be back in just a few minutes.
So we'll be back in a few minutes, but if you do want to post a question in the chat box, I'll be monitoring those.
Okay, I guess we're back on here. It's been about 5 minutes, and Tamara, I think you're out there, and if you want to read me a question, I'll either answer it or evade it.
I will. I've got kind of two questions that go together here. The first one's from Hendricks County, and it says, what is the practical impact of giving property tax relief to property that has already reached its tax cap? And another related question is, going back to that, is property tax relief taken off before the tax caps are determined?
Okay, boy, that's just an excellent question, and the answer to the second question is yes. The tax caps are applied last. Everything else, you know, all the calculations on assessed value and deductions and the tax rate and the Lloyd's credits and all of that stuff is done, and then you get the tax bill and you compare that to the percentage of gross assessed value for the property type, 1% for homes and 2% for rental and ag land and 3% for everything else. You compare that, and then you apply the tax cap credit. So that comes last, and that's extremely important. In fact, the answer to the second question influences the answer to the first. If you are already at your tax cap and you get a local option or local income tax credit, the local income tax credit is effectively subtracted from your tax cap credit. And if the local income tax credit is less than your tax cap credit, you actually won't see any tax relief at all, right? The local income tax credit will just replace the tax cap credit. Only if the local income tax credit is greater than the tax cap credit you were receiving would you actually see some tax relief. So from the taxpayer's point of view, if you're already at your caps, the local income tax credits you might receive are likely to be worth a whole lot less than if you're not at your caps. Now, from the local government point of view, this is one of these cases where the property tax system is turned on its head. Here you are as a local government applying local income tax credits to people's tax bills. You are receiving the income tax revenue to replace the amount of that local income tax credit. But if you've got people already at their tax caps, they're not paying anything less in property taxes. So you are getting additional revenue with no reduction in property taxes, which means that if you've got a lot of taxpayers at their caps, what appears in the law and in an accounting sense is property tax relief is in fact additional revenue. And you know, when you've got a situation where you might have a a jurisdiction where the property tax is capped out, essentially everybody's at their cap, then lit property tax relief, local income tax property tax relief, isn't property tax relief at all. It's additional revenue. And so, you know, if you want to be transparent with your taxpayers, you probably ought to let them know that, you know, for those of you who are not at your caps, if there are any of you there, you're going to get tax relief. Everybody else, you've already gotten your tax relief, and what we're doing is replacing a tax credit that is not funded. That is, the revenue from the tax cap credits is not made up anywhere. It's lost revenue for local government. We'll instead be replacing that with the local income tax credit, which is funded. It's funded by local income taxes. So replacing an unfunded credit with a funded credit means local governments get additional revenue, even if taxpayers don't pay any less in property taxes. So the tax caps, you know, just a few words in the Constitution, wreak havoc with our thinking about everything else that goes on in our property tax system and in our local budgeting. And you always got to pay attention to the tax caps.
So when it comes to property tax relief with LIT, there's some different ways that tax relief can be given, some different categories. This is from Carroll County. What's the timeline for changing the distribution of tax relief through LIT?
Let me see. Let's see if I've got somewhere I've put the time limits on that stuff. Let's see if I can find my list. Here we are. And I will be with you in a second. I will read you off. Here we are. So the dates. If you want to adopt, increase, decrease, or rescind a LIT rate, that if you want to change the rate, if you can get it done before August 31st of the calendar year, it takes effect on October 1st of that year. If you can get it done between September 1st and October 31st, it takes effect on January 1st the following year. And if you do it in November or December, it takes place on October 1st of the year after that. All right, so so you have to keep track of just when it happens. There are deadlines here. So here's the one that you're asked about, though. Grants, increases, decreases, rescinds, or changes a property tax relief credit. If you do it between January 1st and October 31st, it takes place next year. If you do it between November, if you do it in November and December, it takes place the year after that. So if you could do it before October 31st of this year, 2016, it would take effect in 2017. If you do it in November, December, it will take place in 2018. So that's how it goes. All those are in the code. That's the 6.3.6-3-3. So Indiana Code 6.3.6-3-3 is where all these dates are. But for changing property tax relief credits, basically if you do it between November and October, it takes place the following year, and if you do it after that, then it takes place 2 years following. I hope that's clear. I always get confused trying to read these things off, but let me say it one more time. Using 2016, if you could do it between January 1st and October 31st of 2016, it takes effect in 2017 for taxes in 17. If you do it in November, December of 2016, it is effective for taxes in 2018.
Great. Okay, so here's another question from Carroll County as well. If the public safety tax is for PSAP, can all tax revenues go directly to the PSAP and no other entity? PSAP's Public Safety Assistance Program, or what is that? You've hit me with an acronym. I think that might be the case. I think that it's,
okay.
I'm wondering if this question is getting at, in the past, sometimes we've seen counties adopt a public safety tax.
Yes. Okay,
and replace general funds, yeah.
That's a good question. So is this a question of distribution to particular agencies? That is, if you identified in the ordinance that, hey, this is going to go to an agency or a special district or something like that, I suppose if you designated the money to go to a special agency like that, that money goes to that agency, and then whatever is left over gets distributed to the county, the city or town. If that's
yes, they're asking.
I'm sorry?
Yeah, they're asking specifically about distribution.
Yeah, okay.
So would it get distributed to, I'm guessing, fire protection?
Yeah.
Or
oh, I see. Okay, if you've got a fire protection district, for example.
Emergency management, yeah.
Right. Well, the way, and you know, we're at a disadvantage with these LITs because we don't have any practice yet to look at, and no examples to give because we're just getting started. But the way I read the law, if you adopt an ordinance and that says such and such amount of money goes to, say, a fire protection district, that money's taken off the top of whatever you've collected from that portion of the public safety expenditure rate, from your public safety expenditure allocation. And so that portion of the allocation goes to the special district you've identified. And then after that is paid, any amount left over gets distributed by the usual formula to the city or town and the county. That's how I read the law at any rate. And I hope that's the correct interpretation. But that's how it looks to me.
We have one last question on LIT, and then we'll go over to farmland assessment. Do counties, and this kind of goes back to, we're not completely done with COIT or CADGET, right?
Right.
The question is, do counties make all allocation decisions on LIT, and towns have no role in deciding?
Again, it depends on if you are a county council county or a county income tax council county. If you've got COIT, if you had COIT, you are a county income tax council county, and the county income tax council makes the decision, and then you have to look at the distribution of population among the cities, the towns, and the unincorporated areas in the county to know who's got the leverage. You know, in a lot of counties where you've got a great big city, Allen County, for example, Fort Wayne has got the majority of the population within their boundaries, and so they've got the majority of the votes on the county income tax council. So basically what they say goes. You know, they cast their votes as a block and they win. In Tippecanoe County here, the county, West Lafayette and Lafayette, none of them has a majority, but any two of them together make a majority. And so if two of them get together, they can pass the thing. In other places, it's even in the places where you have a county income tax council, the county may have the majority of votes, and so what they say goes. So there's a handful of counties where no one unit has control and you got to have negotiation and that sort of thing, but in an awful lot of counties, one unit actually has the dominance. And so so it depends. If you are one of those counties, and those counties again are those that either have COIT or had COIT, the county option income tax, or adopted CEDIT with a county income tax council, those will be controlled by the county income tax council. Everybody else, if you had CADGET, if you had CEDIT adopted by the county council, those counties are controlled by the county council and they make the decisions.
So in this case, that question came from Park County. Park is a CADGET county, and it will be controlled by the county council. Yeah. Yes,
that's right.
So moving over to farmland assessment, we have a question just a couple of doors down from me today in Rossville. Okay. Is the revenue loss to rural towns going to be immediate, or do we have a couple of years to start preparing for the loss?
Well, if you look at the numbers about our projections, and again, these are projections, and so we need to always be aware of that. There's no more certainty in 2 years out like there used to be. But if these final base rates come to pass and we go down from $1,960 in 2017, $1,960 in 2017, which is a certain number, we know that, the DLGIS has already calculated that. We're guessing $1,770 in 2018, so right away, let's see, I'll do a quick calculation here, 1770 divided by 1960, right away that's a 10% drop, and that's the kind of drop that you would notice. So 10% drop in 2018, a drop of bigger than that in 2019, and a similar drop in 2020, and a similar drop to that in 2021. So, you know, in a sense, yeah, you have time in terms of the big increases in the property taxes, but it's going to start right away. If we are anything like accurate, we're going to start feeling it in pay 2018 and for budgets in 2018. The difference in 2017, the 4% drop, It's pretty small, and so not. So I guess if you put it that way, we're making budgets in 2017. When you start to consider your next budget for 2018, you ought to be aware that this might start to happen, and by the time you get to 19, 20, and 21, it should be pretty clear whether you're going to be affected or not.
So, and I guess we should point out there is a fiscal note from SB 308 that was updated this summer. It wouldn't include our updated forecast for the few years out, but it would have those projected losses for this next year.
That is a good point. So if you look at that, you know, the decline in 2017 was only 4%, but to some degree anyway, the effects are proportional. So if we go to a 10% decline, those that got hit by 4% decline will get hit harder by a 10% decline. You can't always count on that because you got these tax cap thresholds. And so it could be that, you know, if your tax rate is 1.7, goes up to 1.8, there's no effect. It goes up to 1.9, it goes effect, no effect. 2%, no effect. You hit 2.1, all of a sudden all your rental housing is eligible for tax cap credits, and all of a sudden you're hit. So there are thresholds on this thing, but I think if you're being affected, if you're one of the units being affected in that fiscal note by a 4% drop, you'll probably also be affected quite a bit by a 10 and a 20 and a 40% drop. So yeah, that would probably be a way to get a hint, at least, if you're on the list or not, at least right away. But remember, there are those thresholds, so there's no guarantees.
So another question from Hendricks County. Excuse me. Been trying not to do that this whole time.
And that's why she's in Rossville and I'm here.
Yes. Wouldn't it be more efficient to set the base rate each year rather than tinkering with the formula to reach the desired rate?
Well, it depends on your point of view on that, I guess. Now, I'm not sure whether the question means using 6 years of data or just taking a single year. You know, we used the 6 years of data. That was an attempt to iron out the fluctuations. And if you look at some of the tables that I showed you for the old capitalization rate, what would have happened? Excuse, let me find that table here on my own. What would have happened to the base rate if we had been using just a single year? It would have been 1170, then 1125, then 1927, then 2508, then 2066, then 2621. That's a good deal of variation. I mean, we had a good deal of variation anyway, but that's, you know, practically random, and that's tough for farm taxpayers, and it's also tough under the tax caps for local governments as well. And so the fact that we do a 6-year average less the highest number does even out some of those fluctuations. Now, you know, if the question, I guess, could you read me the question again and see if there's more to it that I haven't picked up yet?
Just wouldn't it be easier to set the base rate each year rather than tinkering with the formula to reach a desired rate? Well,
you know, in a sense, you know, it depends on what you think the motivations of the of the legislature are. There's no doubt that that agriculture was looking for a tax break, and there's no doubt they got one. Remember, there are constitutional limitations. The Supreme Court says that assessments got to be based on objective measures of property wealth, and the capitalization formula is a recognized method of establishing property wealth. It's recognized by the International Association of Assessing Officers, and so it's conceivable, at least, that the old formula, had it been challenged in court, would have passed muster as an objective measure of property wealth. What is this new thing? What is this new one? If you view this new one as an attempt to stabilize, that is, if we think that interest rates are going to pop up and down around the 6 to 8% range, then you could argue that over long periods of time, the base rate really isn't changed very much, but that we have stabilized the fluctuations. However, if interest rates are going to remain permanently on the low end of that range, or even below that 6 to 8% range, then it is a tax cut. And then it's a little harder to argue that it's actually stabilization. Now, I like to think that there was a good faith effort on the part of the legislative folks who thought up this formula, they looked over the past 20 years. Had they looked over the past 20 years, they would have seen about a third of the rates above 8, about a third of the rates below 6, and about a third of the rates inside the 6 to 8 point range. They'd say, okay, 6 to 8 percentage point range, that's the range. And we showed with that experiment that it pretty much is stabilization. But if that's not going to hold true in the future, if secular stagnation or savings glut becomes the order of the day, then we have a permanently lower base rate compared to what the capitalization formula would produce, and maybe that's a little harder to defend should a court case ever come forward. So I guess that's a very long-winded answer in order to say, yes, of course, it would be simpler just to calculate the base rate and take it for what it is. But for given the difficulties it was creating for agriculture, and given the desire of agriculture to see taxes lower than what they had experienced, that's not what we did.
Well, and I think Hendricks County added a comment of just arbitrarily, and I think that you hit on that. I mean, it has to be based on objective measures of wealth. Yeah. And in ways, I mean, the 2-year lag really actually helps make that a little bit more true to what's going on. But we'll see with the adjusted base rate, if base rate or if interest rates don't rise, is that an artificial interest rate?
Yeah, that's a good point, Tamara. The movement from the 4-year lag to the 2-year lag is perfectly consistent with objective measures of property wealth. It actually improves the formula. It says that we're going to be using data that are closer to the tax year in order to evaluate the value of property. So the 2-year lag is totally defensible. Whether the court would buy the idea of stabilization given the interest rate environment is the other question. But remember, we'll never know unless somebody sues, and it then works its way up into the courts. Is someone likely to sue? I don't know. The trouble with this is that the benefits are concentrated with agriculture, and the costs are diffuse across all other taxpayers. So it's going to cost all other taxpayers just dozens of dollars as far as homeowners are concerned, while saving agriculture thousands of dollars. And so is there anybody out there who is likely to sue to recoup dozens of dollars, and the defenders being those who are recouping thousands? It's a good question. The farmland assessment formula has never been specifically part of a court case. It got reformed after Town of St. John's, just to be consistent with what the court said. But the formula itself has never been challenged. I will say, you're right, this particular method of stabilizing, if that's what it is, stabilization, is unique, as far as I know, to Indiana, and there are plenty of other ways it could have been done, but it wasn't, and it is, in a sense, an arbitrary way of stabilizing the rate, and how a court would respond to that is an open question.
But there are several states that do have stagnant or use static interest rates in their capitalization formula.
Yeah, there's 50 different ways of doing this. Every state does it a little differently. Almost every state uses a capitalization formula of some kind or other. But famously enough, Iowa actually legislates the capitalization rate. They don't even take data out there. They have in their legislation a number, and it might be 11 actually. It's a relatively high rate, and let's face it, agriculture's got a lot of muscle in the Iowa legislature, so you'd expect that they would have legislated a high rate. So they don't do any adjustments at all there. Most places will try to adjust the capitalization rate based on what's actually going on in the interest rate environment, but there are 50 different ways of taxing agriculture and assessing farmland.
Well, I can talk about farmland assessment all day, but we have one last question, and it's really more of a technical question. Jane asks if the questions and answers will be included in the webinar. Yes, we've recorded the webinar today. The question and answer session's included in that, and it takes me a little while to download the recording and transfer it to something that's uploadable for you guys to see, but that will be out sometime early next week, and I'll send that to everyone. She also asked about a copy of the PowerPoint. We included the PowerPoint as handouts in the first email, and I'll also include them. So as long as I have your email address from registering, you'll get an email with the webinar recording as well as those PowerPoints. And also a survey link. So please, please take the survey. Anything else, Larry?
No, I think that's it for me here. What a fun topic, huh? I would like to point out.
Yes, this works pretty well.
Well, it is, and I'd like to point out that farmland assessment is the reason I exist, at least as a Purdue professor. You know, so I get asked this all frequently over the 32 years I've been here. Why is there a state and local guy in the College of Agriculture? And the answer is because farmers pay property taxes. That's why, and someone's got to be here on this campus keeping track of what goes on with farmland assessment and farmland property taxes. So if you hear me expounding on farmland assessment, that's because that's job one for me. It's the reason that there is somebody like me here. Anyway, I'm always glad to be able to talk about that issue in particular. But we've got a couple of really interesting things about to happen in local government in Indiana, and it's going to be very interesting to watch.
Well, thank you everyone for joining us. Larry and I are trying to schedule a TIF webinar, one of everybody's favorite topics. We're both spoken about topics in December, and so as soon as we've got that scheduled, we will let everybody know the date. Thank you, and have a good weekend.
Okay, so long, everybody.